Bob mentioned in his last session, one of the deals that got away was the acquisition of Russell. And that was my most painful thing that got away, because running the NASDAQ index business for 20 years was a pleasure and something that was really important. I love doing it. I have a passion for it. And I do believe that, and you can't, open up a paper without talking about, passive and active, not necessarily versus active, et cetera. So I totally believe that indexing has helped change the world for investors of all shape and size, et cetera. And so I'm delighted that we have three of people I have tremendous respect for, all in the index world, all represent different size and different types of companies, so we can get a little bit into it. So I'm going to introduce them and then let them introduce themselves with some more detail about their companies. So obviously we have Dave Laval. You saw him before. He is CEO of Alarion. We have Sebastian Seria, who is CEO of, is it Close? I've known you all these years as Axioma, but what?
Yeah, I started Axioma 20 years ago.
20 years ago.
And agreed in April
Right.
to sign a transaction with Deutsche Börse, where
Right.
we brought together Axioma stocks and DAX into
Phenomenal.
this new entity called Contigo.
That's excellent. That's great. And then Sanjay Arar of Morningstar. So why don't you guys, Dave, start with you, a little bit about yourself and a little bit about Alarion before we start.
So Alarion is a indexer, a niche indexer that represents midstream oil and gas and especially in MLPs. We are categorized as the benchmark for the MLP space. My history has always been in financial markets and financial products. So I started my career trading, then spent some time at an exchange, the regulatory side, and then at an asset manager, and now I'm at an indexer. So I've kind of circled the ETF and financial products industry for quite some time now.
You've actually worked at all three. I mean, you worked at New York, Amex, NASDAQ.
That's correct. So I started my career on the floor of the American Stock Exchange and ran a broker-dealer there. New York Stock Exchange purchased the American Stock Exchange end of 2008, and so ran a business there. So when I'm in and around the exchange, people, I have lots of friends. So it's good. It's good.
Excellent. Sebastian.
So thank you so much for having me. I started my career actually in academia. I was a professor at Columbia Business School. No booze, please. and 20 years ago, I took the decision to leave academia and start Axioma, which for those 20 years was what we'd like to think of ourselves as a premier analytics provider, mostly servicing the buy side with risk management and portfolio construction analytics. And I'm a bit new to the indexing world. We agreed in April to this transaction where we're putting together Axioma stocks and DAX. And as a result of that, I'm the CEO now of Stocks too. Stocks, you may know, is an index provider very well known mostly in Europe for the Stocks 50 and the Stocks 600. But with the idea of putting together sort of analytics and indexing, we believe we can have an edge in this market. For a long time, we've been servicing the active buy side, but obviously we've seen how the world has changed, and I'm sure we'll talk more about that.
Excellent.
Thanks, John, for having me as well. So my name is Sanjay. I head up the index group at Morningstar, and Morningstar, we actually, perhaps everybody knows Morningstar. We have a lot of diverse businesses which serve retail investors, advisors. And we got in the business, I guess, primarily as an extension of what we do. Our star ratings, which are quite, used as a benchmark of sorts. So we started off, about almost 20 years ago, created kind of more innovative indexes that are driven by some of the research that Morningstar has access to. But over time, I guess I would say that, we started as kind of being more innovative, and now I think we are trying to be more disruptive, where we have benchmark indexes that cover all asset classes, equity, fixed income, multi-asset. And again, I think it's been a wonderful journey, and kind of happy to be here sharing the stage.
Great, thank you. So definitely can't wait to get your insights. So one thing, you're all different kinds of companies, and for me, from my standpoint, I've seen this view from indexing and this develop. It's really moving to information services. It's indexing data and data analytics, right? There's like three legs to the stool, and you're all starting at different places, but you're all seem to be heading in that direction. So just talk a little bit about that. Start with you, Sebastian. Talk about, you started in analytics, but you're adding indexing.
Yeah,
And-
so we're
right.
coming about it the other way around,
Right.
right? I mean, there is a famous case of the indexing company that acquired an analytics company, that's MSCI. We're definitely coming at it from the opposite angle. And this is a natural evolution of where the passive world is going. I mean, it used to be that passive was about market exposure. And over the years, people have recognized that this differentiation about asset classes and markets is not enough to fulfill the investors' needs in terms of passive vehicles. So the world of passive is evolving, and that evolution has to do with both thinking about other kinds of exposures, whether they're thematic exposures, whether they're factor exposures, which are coupled in this world called smart beta. And also across sort of different asset classes. We were restricted for a long time to equities, and of course we're seeing this expansion into other asset classes too. So the world is evolving, and to all of that you have to add, of course, if you want to have exposures that really are addressing the investors' needs, you have to have strong portfolio construction. And portfolio construction is, again, about analytics, right? How do you build those portfolios that are really addressing the client's needs? So naturally, these worlds are coming together.
Yeah. Same question. You've got a research-based index company, right? So
Yeah. So I think the thing that I would say about particularly to Alarion, actually, it aligns with the center in many ways, which is kind of a foundation of research and rigor of that research. And it's that kind of independence, an independent approach to looking at a particular asset class, generating a following, and then building into an indexing business as a result of it. So that independence allows you to have a high quality of engagement with both the buy side and the sell side, which then can lead to an opportunity to spin a business up. And I think as we think about building our business on a going forward basis, it's still that foundation of rigor and research that allows us to get into data analytics, but also to kind of broaden our exposure beyond energy infrastructure and the MLP sector.
Yeah, no, I would echo some of the same things. I guess, it kind of, in our business, everything starts with data. And, we've been a data company for 35 years, and I think, as they say, data is the new oil. So it actually powers a lot of the things we do. Historically, I think it's all been about equity markets, where we have publicly traded securities. That world is evolving quickly. I think we've seen a lot of private equity data, which, again, I think Morningstar acquired a company called PitchBook, and having access to 1.5 million securities that are on the private side, that's kind of an untapped market. And I think as the investing evolves and needs evolve, I think we're looking at how we can actually harness some of that data to design better decision-making tools. ESG is another area where I think it's a very complex field. I think people have perhaps, again, I think as the investing in ESG evolves, there are a lot of nuances, and people have a lot of biases and preferences or values they're looking for, and there's no one data source that actually can provide all of that. So being able to gather and source a lot of that high-quality data, I think it's going to be important. And fixed income is another area. I think historically, I think that's been kind of the domain of the banks who actually control the pricing or the plumbing in that space. I think in the last few years we've seen a big shift happening in that area as well. So for us, I think starting and making sure that we have good, clean, long-term historical data which powers everything that we do, I think that's very important. And then everything beyond that, being able to have Morningstar serves asset managers and wealth managers to our direct for asset managers, where there's a lot of analytical tools that are developed. And then in addition, I guess we have the indexes, if you're looking at understanding the drivers of performance. So there's a natural convergence, I guess, in our businesses where data powers everything that we do. It starts with that. I think helping portfolio managers understand the drivers. And then also from an investment perspective, I guess if we have good indexes, they can also serve as a good bogey or a benchmark to serve as investment products as well.
Go ahead. Please.
No, I was going to add one thing, which I think is important. Why is analytics so important? And I think that when you make investments in markets and what you're looking for is quote-unquote simple market exposures, the investor can quote-unquote easily verify that whatever you were sold really agrees with the performance that you had. The more you start bringing other data and more sophisticated exposures into the construction of these passive vehicles, you need like the forensic science to tell you that the story that you were told when you made the investment is really what realized in terms of the performance and the sources of risk of the instruments you invested in. And that's why analytics becomes so critical, because from an investor perspective, how do you verify that the story you were told when you made that investment really agrees with what you got, right? And it's only analytics that can tell you that story. It's not so simple anymore that you just look at the market and you say, oh yeah, this moved like the market. So those complex exposures, have to bring analytics to have a comprehensive value proposition.
So this is a fascinating conversation in a very index geek way, right?
Right.
So when you're
I'm sorry,
thinking
this
about
is a room full of index geeks.
yeah, so
right?
when you're thinking about, and with with tremendous respect for the businesses, when you're building analytics, that data, that quality of data is critically important. When you haven't yet fully spun up your analytics business, right? It's about how valuable is your data. So we've said that data is incredibly valuable, but for us, and from the seat that I sit in now, with a tremendous, I think, opportunity for growth and a very exciting path forward for Alarion, our data was valuable because of the research, right? And so that benchmark status that we enjoy in a narrow segment of the marketplace that data is only valuable because we established that benchmark status, right? And so, but you establish that benchmark status because of rigor in research, right? So it's kind of a different angle to get to a place where your data is actually valued. From the analytics perspective, you make a perfect point that your analytics are only good if you have clean, quality, historical data. And so it's very interesting to see how we've all kind of come to a different place where there's data value, but you've come from different.
But I think that's the key, right? The question is, and you said it at the beginning, that these things are coming together. Where should they be together?
Right.
Right? So should we be, for example, as an index provider, we don't have our proprietary ESG data. I mean, we work with whatever the client is looking for. So if we cannot, like you guys did, if we cannot necessarily establish that research foundation for our data early on, does that take us out of the picture when it comes to index provision? And I think the answer is no, because providing an index, you should be willing and able to work with multiple data sources. And as long as those data providers give you the flexibility to use those data sources, then you should be taking those as inputs, right? And ESG is a great example because there's not a huge agreement on what the ESG score should be. So you go and talk to a pension fund XYZ or sovereign wealth fund, a different sovereign wealth fund, and what you have is different philosophies about how they see ESG. So if you say, no, look, this is ESG, then you don't have the flexibility to build something which is tailored for what the clients are looking for.
It's very funny, there's this supply and demand element, right? We're in the business of spinning up indexes because we think they're good ideas and we think they're investable and we think that ultimately there could be demand for them, right? But we kind of have infinite opportunities of how we can slice and dice a universe of securities. But it's really the demand equation, the demand side of the equation of where that kind of index or where that index overlays with a particular strategy that can put in a particular wrapper that can, that there is demand for or that someone believes they can distribute into that demand. So it's interesting.
So we touched on a bunch of topics. Let's talk about ESG and spend some more time on ESG because that comes up everywhere all the time. It's one of the pillars of our center here. Rena's a world-renowned expert in ESG. And there is no unanimity at all on ESG anywhere across the board on what it should measure and how we should measure it. And but there's a continual demand for it. So how are you looking at that? Are you spinning up the idea yourself? Is the partner's idea? What do you see? Yeah.
I think this goes back to the point that was just made, which I think is the key point, right? A lot of the things that we're doing, so the question is whether it's bottoms up or top down, right? And I think ESG is clearly something where, although there is an attempt by data providers to establish, because data providers always want to establish their data as the data, right?
Right.
But the clients do not necessarily care that that's what you want to do bottoms up. They care about what they need top down, right? So ultimately, I think ESG is very much driven by the market, and the way that we made that decision is to be open-minded about the data sources that we're going to use to build ESG. And then there's a question of whether you want an ESG tilt or whether you want an ESG filter. And that, of course, has more to do with the portfolio construction to get that ESG exposure that the client is looking for. But when it comes to data provision, I think that the world of indexing maybe goes to a place where index providers are a little bit more open-minded about working with somebody else's data.
Yeah, how do you?
So Morningstar, we actually own 44% of Sustainalytics, which is one of the two big providers, MSCI and Sustainalytics. They have a team of close to somewhere between 400 and 500 people who actually are collecting only ESG data, and they have about 140 product involvement screens for each company. So they have a very kind of deliberate, thorough process in how they do it. And we take a lot of the data and try to make sense of it. Again, I think when it comes to designing indexes, there are different ways of doing it. I think one is taking a little bit more, what is our conviction or view on some of these and standardizing some of these views. Could be gender diversity, could be environmental, low carbon. I think we are looking at a lot of different things. And then the second view is, I think, where if it's a large asset owner or a client who actually wants to express their view and they have a very specific biases about how they want, you can take any topic and I think there are going to be multiple views. Gender diversity is not that simple. I think if you look at products in the market, everybody has a slightly different view. It could be just looking at the makeup of the board, could be looking at the broad company policies and other things. Likewise, we were working with a large asset owner in Europe, and controversial weapons could have a very different definition. I mean, it's cluster munition and could be nuclear weapon, could be white phosphorus. Having a team of experts who can actually engage with the client and educate them as well, I think it's very helpful. And so we feel that our partnership with Sustainalytics has been tremendously helpful, where there's no one person who knows all on these topics. I mean, I think on traditional indexes, I think when we are doing market cap weighted, market exposure indexes, it's almost a science. I think within all of the major index providers, you can stack their indexes next to each other. I think there's going to be a very high degree of correlation. So there's very little ambiguity, I guess, that's as far as that field is concerned. But where I think you're going to see a lot of kind of artwork or maybe convictions or values or beliefs of people, individual beliefs are going to be baked in. I think that's going to be ESG, and I think that's an evolving area.
But John, I think this is we're touching, I think, on the key topic here, which is active versus passive to some extent, right? And that is that the way I tend to think about it, and pardon the analogy, but I tend to think about Lego blocks, right? And it used to be the case that they used to make them, my old age, they used to make them rectangular and square, and they came in 6 colors, right? And for a long time, the asset owners were using those Lego blocks to put together the strategy that was the strategy that they were going to implement in their pension fund or endowment or whatever that was. And they were helped by the consultants to put this together. Now, I don't know if you ever tried to make stuff that looks real with Lego blocks, but if you try to use rectangular and square Lego blocks, I mean, it really takes a lot of talent to do something like what you really want, right? Now, the world today is that the asset owners are saying, no, I don't like that card that doesn't really look like a car. It's just a bunch of square things put together. I like something that really looks like a car, which means that now I'm going to start putting together those Lego pieces that need to look in a particular way. And I think if you want to do that, indexing or passive or the new passive is a great way to build those Lego pieces as they come today, which is in the shape or form that you want to put together the figure that really looks like a car, right? And I think that's our role to a large extent. Our role is to put together those more granular Lego pieces that are going to help the asset owners, put together the investment policies that they're looking for.
Good thing for us, Legos have only gotten more expensive, so I think we're in a good
We're in a good
trend
shape,
there.
right?
Yeah, we're in good shape.
So passive active is one of the toughest ones to touch upon, but related to that too, and this is particularly I think with ESG, is short-termism and long-termism, right? So indexes like the S&P or the NASDAQ 100, these indexes, they're calculated real time, all day long, tick by tick or second by second, millions of indexes end of day, and they're reflecting very, very short term, right? But if you look at something like ESG, by its very nature, is going to take time to prove itself out. And is it really, how feasible is it that these things are going to take off as values when everyone is so focused in the market on short term?
So I would answer that in a little bit of a different way. Our feeling on ESG and our kind of future strategy is not fully formed, but I think what's most important about addressing kind of an ESG strategy is to build it for the customer. And so the reality that this notion of instantaneous is really the experience of, right, that kind of next generation of wealth transfer is going to want, and going to want to be able to see and touch and feel. Additionally, they're going to want to have autonomy over the construction of what their portfolio is going to look like. And so I think it's critically important to kind of, at least for our perspective, to keep in mind that user and where that demand is ultimately going to come from is going to need to be something that does have immediacy to it, but also has an ability to be customizable. And so being in the indexing business, and perhaps we don't know precisely where our industry is going, but there's going to be a higher demand for it, I believe, and there's going to be a tremendous need for being nimble and being able to craft and spin up indexes that could be, for a user of one. And so I think when you're talking about ESG, we've talked a lot about the reality that ESG means something different to anybody or to everybody. And so the ability to be nimble in delivering that value to that individual who wants that immediacy, but also that autonomy, is something that I think is going to win in the end.
So John, I think your question, I would maybe interpret it a little bit differently in the sense that I think indexes serve a lot of different functions. So the real-time function is vital because I think if you want to keep a finger on the pulse of what the market is doing, I think you need to, people are fascinated. I don't know if it's right or wrong, but I think it kind of gives you a good indication of where the market is in the short term, and I think it serves a purpose there. But people who are looking for investing, I think by and large, I think these are good building blocks, long-term enduring building blocks. I think structurally they are sound and low cost and all the other benefits. We had a conversation with a client who was looking for ex-fossil fuel, and this is part of their belief system, and they're not going to change that on a minute-by-minute basis. I think this is something they believe in. They want to express that through their portfolios, which means I think they'll be very much aligned with those values. And they would, once you create something bespoke for them, I think they will actually stick with that for the long run. So within our indexing practice, I guess we look at, there's the market monitoring function, there's the benchmarking function, there's the analytical function, and then the investment function. And the investment function, for the most part, I think we believe that should be kind of long-term, and most people kind of view it that way.
So that's a great point. But if you dig into the investment side of it, we just look at the investment side, you can even go kind of more granular, right? And so there's a number of different index-based products and different wrappers that you can deliver a particular solution to. And one particular wrapper might not be feasible for a subset of the industry versus another wrapper. I often say, and people have said ETFs, right? Oh, we're in the 5th, 6th, 7th inning of this baseball game. And I say, I think we're like in the 1st or 2nd inning, right? And that's based upon truly the lack of institutional adoption, kind of broad strokes, and the inability to really kind of distribute these products around the globe. This is a global market. And so I think that, again, back to our point of kind of speaking your own book about indexing having a future, there's a number of different financial products within the investment universe that can deliver to a very broad range of investors.
So, but I think as going back to sort of the ultimate client, which is what's important here, which is the pension fund, the endowment, the sovereign wealth fund, I think they clearly understand that some vehicles that they invest in are super long-term, and that's why you see the success in private equity. And they're not worried about putting money in private equity that they're not going to get daily marks. I think what has really happened is there's this, overall consciousness on implementation and fees, right? And I think that one of the reasons why indexing is attractive to asset owners is just because of the low fees, right? It's a transparent instrument. It's you can check it minute by minute, second by second, so you really know what's going on. It has low fees, and it's completely transparent to the investor, right? Ultimately, that's what I think they're insisting in. And if they need to make long-term investments, they will make long-term investments. And at some point, they may challenge the private equity fees too, the same way they've challenged already the hedge fund fees, right?
Absolutely. And before we move on, so thanks for the baseball analogy, so we can just bask in a moment for the Nationals winning the World Series here in Washington, D.C. Long time coming. We won't talk about the other professional sports teams in Washington, a football team in particular. But anyway, There's so many issues wrapped up here. So if you think about indexing in basic construction, just very simple, right? You have data coming in, you have an intellectual engine, right? You have people, everything that are taking that data and doing something with it. Then you have to have a technology component that makes calculation, and then you have to figure out ways to get it out, dissemination. So my opinion has always been that the biggest competitive advantage was always that intellectual capacity, that you design your index design and the rest of it. But now, I think every component is up for grabs. I mean, data is not necessarily a sure thing. Equities is one thing, right? That's pretty straightforward. But every other asset class is challenged in getting clean data, getting data or access to data. You may not even be able to buy the data you want to buy, et cetera. So I think data is a challenge for indexers. Technology, it is tough to keep up with making sure you have a scalable, robust technology platform today, business continuity, all those kinds of things, and then dissemination, right? There's a lot of people out there competing. So talk about those 4 components and add any others that you want to mix, and what are the challenges you guys face as you are running and building and scaling up a global index data and data analytics company on those kind of attributes?
I think you covered virtually everything. I think human capital, so I think the indexing practice has evolved quite a bit. I think, traditionally, I think it was capturing the market, what's trading in the market and market cap weighted. So basic principles of indexing were, they're pretty much set. That's actually the CFA Institute's list, what are the 7 best practices of good index construction, and I think you can check the box on those things. But over time, I guess indexing as a vehicle has evolved, and I think everybody recognizes that rule-based transparency, I think, as a vehicle is great. And in the last, I guess, since the global financial crisis, what we've seen is, they shift more towards kind of the active components that go into kind of feeding, what we call strategic beta or smart beta. There are many different ways of calling it. And that requires having good, robust research that, you're kind of, treading on the active manager's realm now, I guess, right. And likewise, I would say the active manager are coming into the indexing space as well. But where you need to bring in good research that can actually be, enduring over the long term as well. Investing is it's a very human endeavor, so you want to make sure that if you are going to design algorithms or rule-based methodologies, you have smart people who are actually doing it, good research that can support it. So for us, I think having access to good data was, that's table stakes. You need that. Having, kind of check the box on that. If we are going to get into strategic beta, I think we want to make sure that we have good research that can support all of that. And I think at Morningstar, we kind of, feel very fortunate that we have, one of the largest, equity research globally, that independent equity research. So we tap into our analyst staff who can help us identify, where the mispricing might be or where the competitive advantage of companies can be, and trying to take some of that research but using the indexing as a vehicle, I think that's very important. So the human capital part is becoming much more important as we try to kind of shift our focus from, just traditional market cap weighted indexes to something that's kind of maybe more, delivering a better outcome for the investors. How do we kind of gain the edge? And that's going to come from the human capital.
What I would say is and I think just quoting what Bob was talking about just in the panel before, there's been a significant evolution in the equities markets in terms of the availability of data, the technology, the exchanges. So if you think about, 15 years ago when we started building risk models, just getting a clean historical data feed for equities was a non-trivial task. Today it's much easier. I wouldn't say it's resolved by any means, but it's much easier. So I think these things come together. So what we're going to see next, I believe, is in the fixed income markets, we're seeing the electronification of fixed income markets. They used to be very, the pricing used to be quote unquote not transparent. The data availability was much less. But as these markets evolve and as this electronification takes place, then I believe certainly that data is going to become more available and that technology is going to become more available. So we're going to be able to build sort of better indices for that. But I think the other point that is important for any index provider is, Cliff Asner's famous phrase, which is alpha until it becomes beta, right? Mm-hmm. And I think today, and it used to be the case in equity markets, is people were not talking about smart beta and all these other, sort of more expanded passive strategies because people were claiming that was alpha, right? And that's why active management was so successful. And I think we see the same thing in fixed income happening right now, is that they're saying, no, beta is just market exposure. Everything else is alpha in fixed income. And I bet you, whatever you want, that a lot of that alpha is going to turn itself into beta. But that's going to come together with the evolution of those markets too.
I would think you bringing up fixed income is a really important topic to talk about. And I think what has shed the most light on kind of broadly agreed upon inefficiencies in the fixed income markets, and I've been an equity guy my whole career and been frustrated by the lack of transparency into the fixed income market, has really been an index-based product, right? Until you had an exchange-traded fund that was based on a fixed income index, trading on a very transparent and highly liquid, actionable quote exchange, equity exchange, right? You didn't have the opportunity to really have a defined way or an objective way to say that the way the fixed income markets were working wasn't efficient. So you had this cross section of market structures that lives in a fixed income equity-based product, and that successful implementation of an index into a financial product that has driven a tremendous amount of demand from a broad range of investors, right, has shown that in times of market stress, where the fixed income markets kind of underperform from a liquidity perspective, the marketplace is turning to this index-based product, and it's performing extremely well, and the liquidity profile of it is very high, and the experience of being able to transfer risk in an otherwise less liquid security is happening quite fluently, and investors are having a high degree of confidence. And so, again, it's like the advent of kind of this financial product that happens to be index-based, which leads to market structure changes or changes to the underlying marketplace that will ultimately be a disruptor, which leads me to the point which I think is something that you missed in your description, which is regulation, right? And so, that will put regulators, and there are probably some in the room, in a better position to have data to be able to make an objective decision about the best way for the financial markets to be constructed or to structured on a going forward basis.
But I think that here one thing that we should not forget about. So let's take risk premia in equities. Okay, for a long time, risk premia in equities were well known. And again, let's think about some of that premia was taken out by regulation, and let's just set that aside. But the rest of the premia have been around for a very long time. And people were building risk premia factors or risk premia indices, if you want to think in quotes, already 20 years ago, right, when the quotes were not great, when they were using end-of-month data and everything else. So the premia is there. It's just that it's not really recognized because the markets are not efficient enough for people to be able to replicate that. But it's there. So it takes an education to arrive to that point. So I think what's going to happen in fixed income is those two worlds are also going to catch up.
Right. It's just taking a long time to get there. Guys, make your way to the mics. We have 10 minutes for questions, so if anyone has questions. Yes, sir.
So I'm Bill Cunningham, Creative Investment Research. I want to drill down on the S part of the ESG and in a very specific way. So in 2006, we created the Diversity Fund Index, which was an index that looked at diversity performance as a method of generating alpha. The thesis is simple. In a more diversifying economy, if your company is a white supremacist company and you don't deal with black people or people of color, you're going to lose revenue and profits are going to go down. And that was kind of proven out by the thesis. So what we've seen is the development of other indices that track women. And I'm specifically interested in two things. A, what are you seeing on the women's side? This whole idea of gender equality in terms of pay and the role for indexes. And then number two, you talked about people and the idea that intellectual property is the key with respect to developing some of these new approaches. What are you doing internally to make sure that you have an employment base that is not just, the same white guys who aren't going to be sensitive to these diversity or gender issues in the same way that people who are members of those communities would be?
So I can take that. I guess, we've, at Morningstar, we've actually developed a gender diversity index, which is licensed for product creation. Same thing on the minority empowerment too. I think where we worked with the NAACP, I guess they advise us on what companies we should or what criteria we should use. I wouldn't say that we are experts in all of these issues, but we try to reach out to affiliate groups, like on the gender diversity. I think we work with the YWCA, and they advise us like what kind of profiles we should be looking for in companies that actually who meet the muster in terms of making sure that it's not just looking at if the boards are kind of diversified, which is some people kind of use that as kind of the bogey for gender diversity, but what kind of policies does the company have? What is the overall wage differential between different genders and so forth? So there's a whole slew of things that we are advised on by experts who are in that space, like was on minority empowerment as well. So again, I think as providers of financial solutions or innovation, I think our expertise lies in how we can actually pull some of those things together. But we still have lean on kind of experts in the in the real world who actually have a very defined view in terms of what they see. There are sometimes companies which we don't associate with being kind of pioneers in this area. Like JP Morgan was considered as, from a minority empowerment perspective, I mean, they're doing great work in inner cities and so forth. And for us, that if you're sitting in a big city in financial world, you don't really recognize that. So having a partner on the other end who actually knows that space very well, I think it's always good to kind of bring in when you're developing these tools as well.
So I think that one of the things that we should learn to do when we think about ESG is learn from the Europeans who the way they think about ESG is not, I think you mentioned alpha in your question. And I don't think that's the right measure to judge necessarily an investment strategy. I mean, it may provide alpha, it may provide diversification, or it may just be the right thing to do. And I think that what the Europeans, the endowments, the sovereign wealth funds in Europe are thinking is they're changing potentially their investment criteria. And alpha is not the only thing that drives those investments. So I think it is important that we broaden our concept of how we think about making these kinds of investments and not just think about alpha.
Right, and in some cases, actually, if you have strong conviction, like the Norwegian pension fund, I mean, I guess they have very strong conviction against fossil fuel, and they've actually made sure that they actually eliminated all fossil fuel from their fund. And they've done studies, or people have done studies, actually, if they had included, the energy companies, they would have generated some marginal alpha. So they're compromising some alpha, but they are steadfast in their beliefs that this is what they believe in. And I think even though they own one of the largest deposits of oil, I think they want to make sure that they're actually not contributing any further than what they're already benefiting from that. So in our view, I think the way we kind of pitch or talk about this is you're creating a social alpha or ESG alpha, but it's a market beta. So you're not trying to generate alpha per se, but it might lead to, because you're actually doing good and kind of by investing in companies that are actually doing the right thing for be it gender, be it other issues as well.
I think from a leadership and leading an organization, I think one of the classic missteps that I've seen in my career from other leaders is to hire people that have a similar background to them, that look and feel and talk the same way as them. It's been something that I have really put a focus on in terms of building a diverse organization. I like to talk about kind of cognitive diversity. And so I want someone to be on my management team, my leadership team, that's going to challenge me because they bring different perspective to the conversation. And I think that oftentimes we act out of observations, and those observations can be not well-founded. Perspective that you have experienced can bring actual value to, again, cognitive diversity, and then a really healthy debate. That healthy debate can push your organization and challenge your organization to kind of grow in more thoughtful ways. And so I think you raise a very good point to ensure that you are building and you're focused on, you're committed to building, a diverse team within your organization, because that can only kind of power you to go forward and serve the broadest range of clients.
Yes, ma'am.
Yeah, hi. Thanks for the panel. My name is Li Yang. I think for indexing on the stock market and the economic situation, all depend on the data. But the data usually is not reliable. So first, and the government have some kind of revolving doors. Good or bad, really depend on their influence, and the influence, good or bad, is a big question. So exactly how do you give to the government officials or those task force or commission to give them a good suggestion? How do they really make a good judgment to make a good resolution so we can have, the consumer can have a more dependable official policies, and the welfare or well-being of the people will be better rather than depend on some kind of arbitrary manipulation.
Okay.
You know, a lot of the work that we do is actually based off, you know, securities that are publicly traded, or, you know, it's publicly available, accessible data. So, you know, all equity markets, I mean, I think they are clearing houses, and they're, you know, they're very, very fairly, there's a lot of great price discovery that happens on those exchanges, and I think that feeds into the indexes that we construct on the equity side. So by and large, I don't think we actually have a lot of kind of government or kind of issues that, you know, from a pricing perspective, and, you know, from other data too. I think if it's fundamental data, I think we have sourced, you know, 10Ks, 10Qs. I think so we have teams of people who actually do that. So in most of the work that we do, we don't actually encounter like any government influences or interventions that we have to deal with. I don't know about you guys.
Yeah, I think the bigger issue is the underlying markets. The more organized and regulated the underlying markets are, the better the data that comes out.
Correct.
And the more accessible it is. So equities are ahead of the curve, but as other markets get organized and things like that. We'll take one more question, and then we're going to break for lunch. These guys will be around, so you can grab them then. But just go ahead and take your last question.
Thank you, John. Ashu Vermani, Fuzzy Logics. My question is more about the business and pricing. So this is the 16th conference I've attended in the same space, and at least the last 5 of them I've heard the thought that
I'm
the fund
sorry,
fees...
16th, but the best, I thought you said.
But the
right?
best,
Okay.
yes. The fund fees, with the pressure on fund fees, right, you're no longer able to charge, you know, 100 bips or 80 bips, right? They're compressing down to 45 bips. As a result, the percentage of licensing fees that is going to the indexer is a disproportionately high number, which obviously is going to put pressure on the entire indexing business. That is one phenomenon. The other phenomena that you may have heard is self-indexing or direct indexing, where asset managers are leveraging technology to do this stuff in-house rather than go to an indexer. Given that market dynamic, what initiatives do you guys have seen or done internally to make sure you stay lean and come out of this, you know, unscathed?
So one of the things we've actually at Morningstar we've done is, I think 3 years ago we launched this Open Index project, which is, and think of this as an open source you know, program where we actually, anything that's market cap weighted benchmark, I think in our view that's actually commoditized. I think anybody who's got access to exchange feeds and, you know, corporate actions, they can actually maintain that. You know, there could be different views, but that's our view. I think that we feel that, you know, beta is beta. I think, and we've actually gone out and kind of gave, you know, we basically make it's about 100 indexes. We make it available. Anybody who wants to use it for benchmarking, any client reporting purposes, they can use it for free. So that's, you know, service that we actually offer. It's actually in our products. People actually, we've had 150, you know, organizations globally who actually signed up on that program. You know, again, I think we see, I think there are parts of, you know, what we do, I think where there's a lot of value add that we bring to the table, be it ESG, be it some other asset classes. And there, I think, as a business entity, I think we do have to charge, but there are parts of our business where we think, you know, there's, you know, the world's changed quite a bit, you know, the last 20, 30 years. And, you know, there's some of these things have become much more commoditized. So making that accessible and available, given the fee compression in the asset management overall, I think, you know, we are making that available for free, most of the benchmarks that we have.
Yeah, I think I would close by saying there is a gravitational pull, as I like to call it, towards low fee or no fee. But I think there's kind of a barbell that's kind of existing, where there's extremely low fee product, and then there are other products that demand a higher fee. Everyone talks about fees, and underlying those fees are costs, right? And there are costs to business, and there are costs to running your business, and we talked about many of them. Human capital is not cheap. Data is not getting cheaper. And so we have to take into account what your fee is going to be based upon what those costs are. And yes, we can make a very sound argument for the commoditization of some very basic indexes and index principles that could be very difficult to command a high fee because there aren't a tremendous amount of costs underlying them. When you're starting to talk about some of the advancements in indexing and you're looking at human capital being put to work by looking through 10Qs and 10Ks and 8Ks and other sorts of data that's more complex to mine, it's very difficult to commoditize that. So I think there's a barbell that's existing in the market.
I think there's a couple of questions here which are important. And the first is, what are you getting from the index provider? And if you're an ETF issuer and you really want to use the brand of the index provider because you believe that that's important for your ability to be able to commercialize that ETF, then you should be paying fees accordingly because you're leveraging that marketing brand, that knowledge, that research that goes into the market, and the fee structure that you should have is one. The other one is that when you don't care and you're using your own brand or you don't believe the brand of an index is not that important, then you should really pay more or less depending on how much IP goes into the construction of that. So the pricing model should be consistent or correlate very highly to the value of the IP. But again, I want to go back to a little bit sort of where everything is going here. I think what index providers have become is very efficient generators of IP that leads to investment vehicles. And I think that one of the issues, going back to the notion of costs, is that the asset management industry, for a variety of reasons, has not really gone through that modernization that allows them to significantly bring down the costs. And I'm not going to tell you the horror stories that I see, but I see a lot of them. And a lot of it has to do with just the basic principle that when the asset management industry had to modernize itself is when the financial crisis hit. And there was the aftermath of that, and they didn't modernize then. And now that they need to modernize, their margins are shrinking because there's all these low fee products that they're competing against. And at some point, they're going to have to bite the bullet and make that investment to modernize themselves. Otherwise, they're going to be disrupted. So the asset management community also needs to do their part and not just claiming, well, my fees are going down, but what are you also doing yourself to modernize?
So that's a great point to end because that will be the topic of a large part of the FinTech conversation this afternoon, financial services. We're going to lunch. Lunch will be second and fourth floor. The box is out there in Fisher Colloquium. So before we break, back here at 1, let's thank our panel. Great job, guys.